This is a catalytic converter. That honeycomb structure under your car bolted to the exhaust system, converting toxic emissions into something the atmosphere can tolerate. Cost about $1,800 to replace at the dealer. Seems like an overpriced car part, until you realize what's inside. 7 grams of palladium. At today's price, that's $720 worth of metal in a component most people forget exists until it fails. Yesterday, palladium closed at $3,247 per ounce. 3 weeks ago, it was $1,890. That's a 72% move in 21 days, the fastest sustained rally in any major commodity since rhodium's spike in 2021. But here's what's strange. The rally isn't slowing, it's accelerating. Monday, up 4%. Tuesday, up 7%. Wednesday, up 9%. Thursday, up 11%. Each day larger than the last. That's not a rally. That's a short squeeze meeting a supply panic, meeting an industrial buyer scrambling for inventory that doesn't exist. In the auto industry, every manufacturer from Toyota to Tesla to Ford just discovered they have a problem that money alone cannot solve. Here's what they're not telling you. On January 20th, at 2:15 p.m. Moscow time, Norilsk Nickel, the Russian mining giant that produces 40% of the world's palladium, issued a force majeure notice to all non-Russian customers. Force majeure. Legal language meaning, we cannot perform our contractual obligations due to circumstances beyond our control. In commodity markets, it's the nuclear option, a supplier declaring they simply will not deliver, regardless of contract terms. The notice cited logistical disruptions related to enhanced export compliance procedures. Translation: Russia has decided to weaponize its palladium supply the same way it weaponized natural gas in 2022. The timing is not coincidental. 3 days before the force majeure, the United States announced new sanctions targeting Russian commodity exports. The sanctions specifically exempted palladium, recognizing that cutting off 40% of global supply would cripple American auto production. Russia's response was elegant. We'll cut ourselves off. You don't get to sanction us. We get to choose who receives our metal, and we choose not you. Within hours of the force majeure announcement, palladium for immediate delivery in Zurich was trading at $2,400, $500 above NYMEX futures. By London Open, the physical premium had reached $800. By New York close, the futures price had chased the physical price to $3,247, and the spread remained. At 6:30 a.m. Eastern, on January 21st, Ford Motor Company filed an 8K with the SEC disclosing material uncertainty regarding critical raw material supply. The filing specifically mentioned palladium and noted the company was evaluating production schedule adjustments. Production schedule adjustments. That's corporate language for shutting down assembly lines because you can't get parts. At 9:15 a.m., General Motors filed a similar disclosure. At 11:30 a.m., Stellantis. By market close, every major automaker with U.S. manufacturing operations had filed some version of the same warning. The industry that produces 17 million vehicles annually in North America just announced, collectively, that they're not sure they can continue production. This is where the lie becomes unsustainable. The auto industry's palladium problem didn't start yesterday. It started 2 decades ago, when catalytic converter regulations tightened and palladium demand began its relentless climb. In 2000, global palladium consumption was 5.2 million ounces annually. In 2025, it reached 10.8 million ounces. Demand doubled, while supply increased by just 31%. The gap was filled by above-ground stockpiles, metal accumulated by Russia during the Soviet era, when palladium was a byproduct of nickel mining with limited industrial application. Those stockpiles were sold gradually into the market, supplementing mine production to meet growing demand. The stockpiles are now exhausted. Russian state reserves of palladium, estimated at 30 million ounces in 1990, have been drawn down to approximately 2 million ounces. What remains is strategic reserve. Metal Russia will not sell at any price because it represents national security, not commerce. The force majeure didn't create the shortage. It revealed the shortage that was always there, hidden by stockpile drawdowns that can't continue because the stockpiles are gone. At 4:45 p.m. Eastern, on January 21st, Johnson Matthey, the world's largest refiner of platinum group metals, released its annual market survey 3 months ahead of schedule. Early release of industry data typically signals that the data is urgent. The survey confirmed what the price action suggested. The palladium market is now in structural deficit of 1.4 million ounces annually. Mine production cannot increase meaningfully. Palladium is almost entirely a byproduct of nickel and platinum mining, and those operations take years to expand. Recycling, the other major source, is constrained by the scrap supply of old catalytic converters. Demand cannot decrease meaningfully either. Catalytic converters are legally mandated. Every gasoline vehicle sold in the United States, Europe, China, and Japan must have one. Substitution with platinum is technically possible, but requires reformulation that takes 18 to 24 months to certify. For the next 2 years, the auto industry needs more palladium than exists. The force majeure removed 40% of supply from an already deficit market. The math produces the price action you're seeing. When industries face this kind of supply shock, the response follows predictable patterns. Stage 1. Denial. Manufacturers claim adequate inventory and dismiss supply concerns. This lasted about 6 hours on January 20th. Stage 2. Quiet panic. Purchasing departments scramble to secure spot supply at any price. This is happening now, and it's why palladium is rising 8 to 11% daily. Industrial buyers are bidding against each other for metal that's already been sold 3 times over. Stage 3. Operational impact. Production lines slow or stop as inventory depletes. This begins within 30 days for manufacturers who didn't hedge, within 90 days for those who did. Stage 4. Demand destruction. Prices rise until demand decreases to match available supply. In palladium, this means vehicles don't get built, which means consumers don't buy cars they can't purchase, which means the economy contracts. We're currently transitioning from Stage 2 to Stage 3. The 8K filings from Ford, GM, and Stellantis are the first public acknowledgement that Stage 3 is imminent. Less than 45 days of palladium inventory remain in the Western industrial supply chain. That estimate comes from the International Platinum Group Metals Association, which surveys refiner and end-user stockpiles quarterly. 45 days. That's how long the auto industry can continue current production rates without new supply. After that, every vehicle not built represents lost sales, laid-off workers, and cascading economic impact through the supply chain. The force majeure hasn't been lifted. Norilsk Nickel has provided no timeline for resumption of Western deliveries. Russian government statements suggest the restriction will continue until the sanctions environment stabilizes. Diplomatic language for indefinitely. At 11 p.m. Eastern on January 22nd, the White House convened an emergency meeting of the National Economic Council to discuss critical mineral supply disruptions. The meeting's existence was not officially announced. It was reported by Reuters based on vehicle movements and calendar analysis. When the White House holds unannounced late-night meetings about commodity supply, the situation has moved from market disruption to national security concern. While the auto industry panics, the financial squeeze intensifies. The palladium market has characteristics that make short squeezes particularly violent. Total market size, approximately $35 billion annually. Tiny compared to gold, $200 billion, or oil, $2 trillion. Small markets move faster on supply shocks because less capital is needed to move prices. Physical deliverability, concentrated in a handful of refiners and vaults. Unlike gold, which has deep and liquid physical markets globally, palladium physical delivery depends on a few counterparties. When those counterparties can't deliver, as is happening now, the squeeze has nowhere to release. Short interest, approximately 2.3 million ounces net short among commercial traders as of the last CFTC Commitment of Traders report. Those shorts were betting on price declines. They're now facing margin calls and forced covering in a market with no physical supply to cover against. At 8:30 a.m. Eastern on January 23rd, NYMEX issued a special notice to Palladium clearing members regarding enhanced margin requirements and position verification procedures. Margin increases during a rally force shorts to either deposit more capital or close positions. Closing positions means buying. Buying drives prices higher. Higher prices trigger more margin calls. The feedback loop is self-reinforcing and won't stop until either shorts are fully liquidated or prices reach levels that destroy enough demand to create equilibrium. The target for demand destruction in palladium is not $3,200. It's not $4,000. Based on historical demand elasticity in automotive applications, the price required to meaningfully reduce demand by forcing production cuts and accelerating substitution is approximately $5,500 to $6,200 per ounce. That's 70 to 90% above current prices. And current prices are rising 8 to 11% daily. The mathematics suggest $5,500 palladium within 30 days if the force majeure remains in effect and the squeeze continues. The secondary effects amplify the primary crisis. Palladium isn't only used in catalytic converters. It's essential for electronics, multi-layer ceramic capacitors, which are in every smartphone, laptop, and data center. It's used in dentistry, palladium alloys for crowns and bridges. It's used in chemical processing, palladium catalysts for pharmaceutical manufacturing. Each of these applications is now competing with the auto industry for a shrinking supply. The electronics manufacturers who source palladium for capacitors are being outbid by auto companies desperate for catalytic converter material. The dental labs are simply stopping palladium-based procedures because they can't source material at any price. The supply shock radiates outward from automotive into every industry that depends on platinum group metals. And because palladium, platinum, and rhodium are mined together, the stress in palladium markets creates secondary stress in related metals markets. Platinum is up 23% since the force majeure. Rhodium, already scarce, has added another 31%. The entire platinum group metals complex is repricing based on the recognition that Russia has weaponized supply and can do so again for any of these metals. At 3:15 p.m. Eastern on January 23rd, the CEO of Anglo-American Platinum, the world's largest platinum producer, gave an interview to Bloomberg in which he stated, "We are receiving calls from automakers we've never worked with, offering prices we've never seen, for delivery timelines we cannot achieve. The market has fundamentally broken." Fundamentally broken. From the CEO of the largest non-Russian platinum group metals producer. That's not market commentary. That's industrial intelligence from the supply side, confirming what the demand side has already filed in SEC disclosures. The investment implications extend beyond palladium itself. The palladium squeeze is creating opportunities in related areas that most investors haven't considered. Platinum, trading at $1,450 versus palladium at $3,247. The metals are partially substitutable in catalytic converters. Auto companies that can reformulate for platinum will do so, eventually. That reformulation creates demand surge for platinum beginning in late 2027. Platinum's current price doesn't reflect that coming demand. Palladium recyclers. Companies that recover palladium from spent catalytic converters are suddenly processing material worth 72% more than 3 weeks ago. Their margins have exploded. Stocks like Umicore, BASF's catalyst division, and specialty recyclers are repricing to reflect the new economics. Automotive supply chain. Every vehicle not built because of palladium shortage is a vehicle someone wanted to buy. When supply normalizes, eventually, deferred demand will create a production surge. Auto parts suppliers with capacity to scale will benefit. Alternative technologies. The palladium crisis accelerates the transition to electric vehicles, which don't require catalytic converters. Every automaker is now doing the math on accelerating EV production simply to avoid platinum group metal exposure. Tesla, already EV only, faces no palladium risk. Legacy automakers face existential supply vulnerability. What the informed understand is that the palladium crisis is a preview. Russia controls dominant positions in multiple critical materials: palladium, nickel, uranium, titanium, platinum. The force majeure playbook, weaponizing supply in response to sanctions, can be repeated across any of these commodities. The auto industry's palladium panic today is the semiconductor industry's neon panic tomorrow. Is the aerospace industry's titanium panic next month? Is the nuclear industry's uranium panic next quarter? Each supply weaponization follows the same pattern. Years of complacency about concentrated supply, sudden disruption when the supplier decides to exercise leverage, panic buying that depletes inventories, price spikes that destroy demand and cause economic damage. The palladium spike to $3,247 isn't an isolated market event. It's a demonstration of what happens when critical supply chains depend on adversarial nations, and a preview of what happens when those nations decide to use their leverage. Physical positioning matters more than financial positioning in a supply crisis. You cannot take delivery of palladium futures if no palladium exists to deliver. You cannot hedge supply risk with derivatives when the underlying commodity isn't available at any price. The auto companies discovering this now are the same companies that could have built strategic reserves, diversified suppliers, or accelerated substitution programs years ago. They didn't because just-in-time inventory and cost minimization were more important than supply security. They're learning the cost of that prioritization in real time, measured in production lines going dark, workers being furloughed, and a $3,247 spot price that was $1,890 3 weeks ago. The palladium at $3,247 today maybe palladium at $5,500 in 30 days. Or it may collapse if Russia lifts the force majeure tomorrow. Supply crises create volatility in both directions. But the structural lesson doesn't depend on where palladium trades next month. The lesson is that physical possession of critical materials, whether palladium, platinum, silver, gold, or any commodity with concentrated supply, provides security that paper claims cannot. The auto industry has paper contracts for palladium delivery. Those contracts are worthless when the supplier declares force majeure. The companies that held physical inventory, actual metal in warehouses they controlled, are the only ones still running production lines. 7 grams of palladium in a catalytic converter, $720 at today's prices. The most important $720 in the auto industry right now, because without it, $50,000 vehicles sit unfinished on assembly lines, waiting for a metal that Russia has decided not to sell. The squeeze isn't over. The force majeure hasn't been lifted. The 45 days of inventory are depleting. $3,247 today, $5,500 possible within 30 days. And an auto industry discovering, in the most expensive way possible, that supply security isn't a cost center, it's an existential necessity. Reality is asserting itself now, 7 grams at a time.